Quantitative easing is a word that we used to hear a lot. This was in the last decade. We had first quantitative easing, and then it kept happening. So we had QE2, QE3. I don't know. We might be on to QE5 or 6 at this point. This is when the Fed is doing something squirrely and buying their own treasuries and monetizing debt. And it just seems like a circular rabbit hole of making money. I think we need to understand this better because from what I understand, you think we're on the cusp of another round of this. Like we're going to see quantitative easing happening again through revised Fed policy.
I don't know that we're going to see it again. The word today is about quantitative tightening. However, I do hear more people who are beginning to question how banks handle our money and what the relationship between commercial and private banks is. And as they do so, this word quantitative easing comes up more often. And so I think it's interesting to begin to understand what economists and politicians mean when they say quantitative easing, what they mean when they say quantitative tightening. But
Quantitative easing, the way that I understood it canonically, was where the Fed was buying the debt that was being produced by the U.S. government. It allowed for essentially the Fed to be in a circular hole of they're creating the money and then the government is spending money they don't have. No one is interested in buying those bonds, and so then the Fed buys the bonds. It always seemed like just this weird situation of money going around in a circle and essentially just like doling out money to the US government that they didn't have to collect through taxes and just massively devaluating the currency.
wow, you said some key things there. Instead of raising taxes, I think that's the maybe the chief issue at hand. It's not only we say the Fed buying bonds that they've created. Well, the Treasury created the bonds, and the Federal Reserve was supposed to find banks, and the banks are supposed to find people for whom to sell those bonds to. But when the debt of the government is increasing at such a rate that there is no one willing to buy those bonds or to buy that debt and to hold on to it, then they have a problem on their hand. And so what the Federal Reserve does is to turn around and hold on to those bonds, or ask some of the other banks to put those bonds in their reserve accounts. And I guess the key thing here too is that they begin to pay interest on the reserves that they're holding for their member banks. So now not only are you getting interest on holding on to treasuries or to selling treasuries, but placing them in a reserve account at the Federal Reserve is paying interest back. And so part of the reason I guess I think maybe it would behoove us to also have a conversation about the history of the United States government selling treasury bonds and how that system came into being. Are you willing to take a walk back to history, back to the Civil War?
I mean, if there's anything that I love about the show, it is going into the deep historical roots of things that are happening in our modern day. And I am not surprised or shocked to say that you're going to take us to the Civil War. It seems like everything in America pivots on this one moment, this one thing that happened in American history. So take us back.
Okay, well, 1861. I'd say remember. So in 1861, some of the southern states began to break away from the Union, and they broke away whenever Congress was still in recession. So Lincoln, on the power of executive authority and without the approval of Congress, that would later that he would later get from who was left in Congress. Lincoln summoned 17,000 troops into the Union Army to ostensibly go, you know, to go draw those states back into the Union. Well, then he had a larger problem because a lot of the more central or northern southern states also seceded and joined those southern states to form the Confederate Union. But meanwhile, before Congress is called back into session, and what they would eventually do is raise all sorts of taxes, including an income tax, sales tax, liquor tax. Anything that they could tax was what they were taxing. But meanwhile, Lincoln turned to his treasurer, Salmon P. Chase, and said, "Salmon, we need money. We don't have money in the treasury. Go talk to banks, the banks of New York, especially New York City, and ask them for loans." And Salmon went to those banks, and those banks said, whenever you have a war, or if you're what your policies or your bosses, Abraham Lincoln's policies are going to lead to a civil war, and New York City is in the business of selling cotton that's raised in the South to Britain and to other nations around the world. And if you're going to march 17,000 troops, burning and pillaging through the South, and that conflict is going to happen here, you're not going to be able to pay this back. So we're not going to loan you this money. And the public reaction was an outcry against the banks, that the banks were not did not have any patriotism. They did not value the Union, and they were they were evil commercial institutions that only had their business in mind. Now, how interesting is that, for starters, with regards to our perception of banks today and how they make money on war?
Very different from today.
And to me, this is part of or maybe the fulcrum of this great change in the American relationship between banks and central banks, and sort of this bucolic free banking era that exists before the Civil War. I think it's very important to understand that it was that originally the banks said war is bad, war causes destruction. Our profits are based on cotton being raised and cotton being sold.
Production and prosperity rather than destruction and death.
Exactly. So the banks so the banks arms are twisted, and they actually purchase some of these bonds from the government. They buy government debt, and Lincoln later calls or Congress comes into session. Congress again raises all of these taxes later at maybe in November. I'd have to check the actual dates of the year, but they start to raise all of these taxes. They also raise tariffs, but they raise a general tariff and all sorts of taxes to try to pay off this government debt. Meanwhile, or I guess not meanwhile, but as that's going on, the government is also, or Salmon P. Chase, Secretary of the Treasury, is also aware that the government has created more debt, and also that this war, again, the northern states turn around and secede too. All of a sudden, the 17,000 troops don't look like they're going to be enough. The United States at this point has enacted the Legal Tender Act. They're printing greenbacks, and they need to sell more bonds. So they turn to J. Cooke. Are you familiar with J. Cooke?
Sorry, you caught me looking something up. Keep going. I tell us more about J. Cooke, but I was going to get the Legal Tender Act thrown on the screen.
Okay. I grabbed legal tender. Also, J. Cooke. You know, when Sam Bankman-Fried went under for or was taken into custody from from an island in the Atlantic, I immediately thought of Jay Cooke, because it always seems like the United States government can find a fall guy for somebody selling government debt. Jay Cooke was the first bond salesman for the United States, and Jay Cooke went to Salmon P. Chase and said, you shouldn't just be going to bankers, you should be going to every American. Again, the American people had just led through public outcry, through all of the papers, thousands of newspapers, pamphlets. This is a time in America when everybody is engaged in public discourse, like we had 100 Twitters. And Jay Cooke said these people would be interested in supporting the war effort, so we should be selling. We should not just be selling the government bonds to banks, but directly to the American people. So Jay Cooke created a bank, and taking a small slice of the interest rate. And mind you, these paper notes the interest was paid in gold. So I forget what the actual terms were. They had names like the 520, which I believed meant that the government could buy back the bonds in 5 years, or between 5 and 20 years. And I think that they paid 6% interest, and the interest was actually paid in gold. So this would lead to the creation of the paper money system, and also the gold reserve system. Now, so Jay Cooke goes around selling all of these bonds to the American people. His company would later go belly up and cause the panic, or a financial panic of 1873. But this also leads into, because again, the war is becoming more expensive than anyone imagined. This leads into 1862 and 1863, into the creation of the national banking system. And we've talked a little bit about that, but just as a refresher course, prior to the government beginning to create its own money, there was an actual fractional reserve system where banks held on to some measure of gold or silver, and they issued their own notes based on what their reserves were. And those banks were under state charter systems, and the states were in charge of looking at their reserves, conveying to the public as to how good the practices of those banks were. So we sort of back into a national monetary system, and this national monetary system is essentially based on the sale of government debt through bonds. Have I left anything out? Any questions before we move on from there?
Not yet. I do remember Jay Cooke from conversation that we had. This guy going around selling these bonds. This very much is in my memory as something that I had a visual thought of about how this could actually work. And it's very interesting that the bonds are being paid in gold. It sounds like maybe that they didn't last that long, that if some of those gold payments happened, that maybe there weren't that many of them, and that these bonds ended up worthless. Is that how that played out, or did they pay out all the gold? I'm a little bit curious about that.
Well, as they actually had to suspend the payment of the bonds in gold, they did that very early on, and then after that, it would only be the interest of those bonds was paid in gold. So you would get more paper in the future, and a little bit of gold in the future. And this is why the national banking system and the fees of the national banking system, which the national banking system, I believe, had essentially the funds rate, or the lending rate, at 3%, and it assessed upon the states a lending rate of 10%. And that's how the national system both beat the state banking charters, which would later be recreated, but underneath the national banking system, or underneath the national monetary system. So those state banking systems are beholden to but I say national system too. We should be saying federal system, but that's an aside. But pay attention to the creep of national on federal in our parlance, because going back to the Constitution, it was a federal government, not a national government. That was the first and greatest debate of constitutional convention. So we begin to separate the paper from the gold, and you can see, if you pay it's I should say it's very important to pay attention to who gets gold and who gets paper going into the future, because the bankers are incentivized to participate in this system, and they get paid out in gold for the interest, and everybody else gets paper. Now, the first of these bond sales goes to Jay Cooke, goes to the minnows. There's great public buy-in into this system. And you also have to bear in mind that there's a bunch of other liberal policies that the Lincoln government is engaging in, and I'm talking about the Homestead Act, the creation of the USDA, the Land Grant College Act, some of these things that we associate with America, sort of everyman, agrarian, Republican politics, but that had those were, how do I put this, those were desperate attempts by the Lincoln administration to maintain popularity while creating this national monetary system that was to pay for the Civil War. So then, so Civil War is fought, Civil War ends. Jay Cooke goes under in 1873, and coming into the stage in the future, there would be times at which the government needed to sell bonds in the future, and the minnow system wasn't working like it used to. And so then you have the appearance of J.P. Morgan and the Rothschilds in 1895, because the government is going bankrupt in 1895. The paper system is collapsing. J.P. Morgan arranges a deal with the Secretary of the Treasury. I believe it's under Grover Cleveland, in Cleveland's administration. So arranges a bond sale of with the government, and sells 3.5 million ounces of gold to the United States Treasury. And they take a 30-year bond in return for that. I don't know what the terms are, but I think of what is of note here is that we're moving away from the sale of bonds to the American people and into the wells, the financial wells. And those financial wells have been created by the separated gold and paper system that had been in practice now for 30 some odd years. And in 1907,
so if I understand this right, those who pursued gold during this era instead of paper, they were the ones that made out. Is that kind of a summation of what happened here? Chasing the paper, kind of, you got wrecked if you were doing that.
Yes, and people were aware of the difference between gold and paper, or gold and silver and paper. And this is part of why reading newspapers in the 1890s and reading the op-eds and reading the speeches of William J. Bryan and some of these politicians is very interesting, because the creation of the paper, the greenback, federal money system, the federal dollar, was not done in secret. This was an open debate, and you had the likes of especially these farmers that are created through these agricultural acts, the Homestead Act, and the creation of the USDA, the Land Grant College, the opening of lands in the West. All of these people said, "Hey, we need more liquidity," and if the system is only that of the banker system, or if everyone is forced to use gold and silver, there's not enough money for us to be selling all of our produce. So the American people, I mean, remember the words of William J. Bryan, you shall not crucify man on a cross of gold. And that's because the poor people wanted this inflationary paper currency, so there was more liquidity.
Well, and also because if you're borrowing, you want whatever it is that your note is denominated in to devalue over time, so it's easier to pay it back. But that only helps those who are producers. So in a world where most people were agrarian producers, they're farmers, they're producing a crop that should be worth more in the future. If the currency is devaluing, then that means the loan you took out 20 years ago is easier to pay off because the corn you're producing is worth more per unit because the value of the currency has gone down. So an inflationary currency where you're in an agrarian system and you're producing a relatively consistent amount favors the farmer. That's why the farmers wanted this inflationary style currency.
And it does favor the farmer, but in the long run, you can see how financial interest, the middleman, and especially whenever we have now created a national monetary system, but under some notion that we have a private banking consortium or private banks that would later become a private banking consortium are passing this money, and they're the middleman. This is a setup for those bankers, and they're more they're more stable, or their hard money, their gold, to turn around and buy whatever they want. And this becomes the problem in America in 1907, 1913, the problem of the world, leading into World War I. This is why so many countries, as this was a broader effect, and not just in the United States, but in Europe and around the world, this was a problem. I should say this was a worldwide problem. So we continue to have, I guess, an imbalance between who has the real money in the United States. You can pass all the paper around, but as long as gold still is on a par and is appreciating against the growing supply of paper notes and in this increasing liquidity pool, this is the conundrum that the United States finds itself in.
So this idea of having banks buying government bonds, this has its deep historical roots back in the Civil War era. So if we fast forward to now, quantitative easing is not that much different than what we had then, because we still have the Federal Reserve, which is the national banking system, buying bonds, and those bonds are in a large part financing the military and the international conflicts which the U.S. finds itself in. I mean, we're paying a lot for the war machine, and essentially it's this circular buying of bonds that are being created by the U.S. Treasury, mostly to pay for military style spending, being purchased by the Federal Reserve, and that's what we called QE 1, 2, 3, and 4. And are we thinking that we're on the cusp of we're going to see this again because the Japanese are no longer interested in buying U.S. debt?
Well, I mean, one little step in there. Don't forget, in 1913, this federal consortium of banks gets appointed as a quasi central bank for the United States. So, but we need to understand the history of the private nature of those banks and what their relationship was with selling that debt on. So, and also the reserve aspect of it with the dual nature of paper and gold. So, we come to the Great Depression, the decision of FDR to take or to stop. To take gold wholly out of this system, and we would use that going forward in the the projection of the American system onto the rest of the world, and we would promise to pay the world back with the dollars that we created in gold. That didn't hold up, but so to your question, yes, the you know, as we talk about our monetary policy of today, we focus so much on the FOMC board, the Federal Open Market Committee, and the rate that banks that they set for all of their member banks who are ostensibly holding reserves, but those reserves are actual debt, not gold anymore, holding reserves in the Federal Reserve System. So we focus on that interest rate um, rather than the tax rate. And even our politicians, like look how Donald Trump is so focused on a very low interest rate. So that they have an expectation that more people are going to be able to borrow and lend money at cheaper rates. And rather than a conversation about how much the federal government is spending, as opposed to how much they are taking in with taxes, we have politicians who tell us that they can lower taxes and bring in more money. They can lower rates. They can lower the lending rates by the quasi central bank, and people are going to move more money around, and that will that the government can pay its debts by by the increased velocity of that money moving around. And so as I often harp on the lack of manufacturing, the death of manufacturing in America. This is the reason why. Because whenever
This is the word that immediately came to mind when we started saying this. I sometimes words are just like fit the topic at hand. To me, brinkmanship right here is like pursuing a dangerous policy, especially in politics. This this seems like the train is just headed towards the cliff, and we've been waiting for the train to crash into the cliff, and there's no tunnel through it. It's just we are barreling towards what will be the ultimate end of this dangerous policy that the US has been pursuing. And with how fast the money is increasing. I threw this on here just briefly to get a look at this of where we've actually been going with the balance sheet. It's just gotten crazy, and you see where these cute quantitative easing periods have happened. It's really shocking to see what has happened with the US dollar in just recent years.
And as I think back, this was this was a problem that after World War II we projected on the rest of the world. Because if we ask ourselves, well, what happened? What happened after 1930? What happened all the way to 1970? Well, we were creating dollars, but we were extracting or shoveling that creation of debt onto the rest of the world. After 1971 and the Nixon shock, Nixon suspends the notion that we're going to pay all the rest of the countries of the world back in gold for the dollars that we've created. Then we begin to have these interest rates, rising. We have an actual a decline. When we consider the inflation of the supply of dollars as opposed to what the real GDP is, because the government always says, well, our GDP is growing at 2%, maybe 4%. Well, if that's just because they are throwing more money into the liquidity pool and lowering the rate of swapping that money around, and then measuring how much money has transferred from the hands of corporations and people and other governments, then that's not a real domestic product. And that's what's been happening
Right
to
there, that's not real growth of the GDP if the GDP is growing because of inflation. And if the inflation is measured in a squirrely way to make it look lower, then you have this perception that the economy is growing when it's not really growing. It might be stagnant at best, or getting smaller, but only getting bigger because of this inflationary stuff that's going on.
and you say stagnant. What a great word. In the 70s and the early 80s, that's when the United States experienced stagflation. And that was the government, the federal government saying, oh, we can increase this gas fee or this lending rate for the money. And if we raise that higher, 8 to 10%, then we can begin to pay off the federal government's debt. Notice they're talking about fiddling with the monetary policy rather than raising taxes. And despite Americans
I mean,
complaining,
this right here, stagflation, seems like exactly what's happening right now.
it is.
We have every company that I can think of talking about how they're laying people off. So unemployment is definitely rising. Inflation is happening and the economy is stagnating. We are living in stagflation right now.
I would agree. And if we look at the relationship between the politics and this lending rate, politicians realized this in the 80s. This is whenever they started to lower the interest rates, lower them through the 90s. And also, I mean, if we think about if we think about our the American primacy and the American wars, they really begin to ramp up at this time. Nixon's response to a realization of the position that the United States was in was to run to China and also to run to the Middle East and to begin to secure markets around the world, for American goods, but mainly for the sale of American debt. So the what we again, if we take this back to quantitative easing, if you begin to take down this rate and you take it all the way down to zero, at some point you're creating so much money that despite people being able to pass paper around, if there's no expectation that the Treasury bond is going to be any good, or the ability of the American government to pay that off in the future, nobody wants to buy it. And so that's what the government again, if we think about this timeline, we leave the 90s, we enter 2000s. This is when American primacy wars ramp up. We have 9/11. There's a big drop in the funds rate after 9/11, but people are worrying because the government is always talking about inflation, and they refer to price inflation. But those who doubt the paper money system, or what the government is doing with its monetary policy, when they talk inflation, they're talking about inflation of the money supply. And the answer to the political answer to that has been to use policies like quantitative easing to hold money in giant pools, by the middleman, by the Federal Reserve and the commercial banks, so that it does not flow into the hands of the American people. So quantitative easing becomes an actual policy of the United States government after the financial collapse of 2008 and 2009, or and by the way, remember that's also the BRICS. BRICS was the name of foreign investment portfolios in New York, in New York City. And so this BRICS alliance that we have today, that's not what they named themselves. Those are all of the countries that money was retracted from immediately in 2008 and 2009, which gave the United States quite a bit of a buffer. But the United States also had a buffer in these quantitative easing policies, and that was to turn to the commercial banks and say, if you do not lend out the money that we've created, we will pay you interest on those reserves that you hold. And the story that Obama told America at the time was, we're gonna create all of this money, and we're gonna give it to the banks, not the American people, because there's the money multiplier effect of the banks. And if we give money to a bank and they can loan it due to fractional reserve practices, then they can multiply the effect of that by 8 or 9 times. But instead, what the government was doing at the same time was paying those banks not to lend money to people, and this begins, the great separation between the financial sector and the manufacturing and production and service sectors in the United States. Maybe less so the
Yes.
service sector.
Right, because now you have people who are directly next to the spigot of money, and whoever is closest to the money has the most opportunity to profit from it. And that I think is one of the croniest kind of things that has gone on with this monetary policy. And it does tie back to our discussion the other day of, well, what can people do? I mean, if you're in a position where you no longer believe that political movements or populist movements can really affect change, it's because this is where the real power lies. If you think about how power is manifest, it's largely through money. Money can cause things to happen in the world. It can buy things, it can coerce things. It is the tool, it is the thing which has allowed for the expansion of the American empire. So if you can get closer to that money printer, if you can get closer to the spigot of the flow of funds, then you're in a substantially better position than everybody else. And that's where the real power lies.
And I 100% agree. I talk a lot about the carrot and the stick, and there's this notion that we can send the military out to force other countries to our will, but that is incredibly costly. It's better to create a magic scheme, promise to give them something, promise to give them anything, and people will go along with this. And once they have their foot in the door and are caught in the lie, so to speak, it's hard to get them out of it. Putin recently said, with regards to the seizure that Europe and America have partaken in of all of the Russian dollar-denominated assets. We've seized at what, $300 billion worth of Russian assets, and Vladimir Putin, in a speech, said, maybe this is a cheap price to pay to get off of the dollar system. But that aside,
and thus they embrace BRICS, and that's the end of the dollar dominance right there. When that occurred, it was a whisper, not a shout, but it was definitely a herald of what we're seeing now.
and it's also this should also give us a little bit of understanding as to why BRICS is concerned about payment channels, but not creating another currency, not to mimic the mistake of the United States federal dollar system. Because if we go back to that, what happened in 1861 and 1862, we replaced these local and regional banking systems, regional accounting, regional cycles with this great common denominator, the dollar. And that has had its problems. So these countries aren't looking to jump onto a Chinese currency or a Russian currency or a Brazilian currency or a currency of, God forbid, a greater federal union that they create themselves. No, they want to have payment channels that they trust and liquidity held by the various member institutions, and to be able to engage in commerce that is not dependent on any great denominator and an institution that's going to grow up around that great denominator. So there's a lot of talk about what is this BRICS currency going to be. I don't know if we're ever going to see it. If we do see it, I don't know. I would imagine that all the countries are going that of the BRICS system and even of the American dollar system, those that continue to peel off of the American dollar SWIFT payment system, are going to be wary of this problem in the future. But before, because we're closing in on the end of the show, but I also wanted to bring COVID and Trump's COVID response to consideration, because
this was different, because when we talk about who's close to the money printer, Trump put the American people directly in line to the money printer because he made direct payments. We all got those checks that were signed directly by Trump, and the COVID policies and the money policies directly put money into the hands of small businesses. So that was like a mainline injection right into the US economy.
And look what happened to price inflation coming out of that. All of a sudden, many people had money actually in their hands. Did they save that money? Maybe they paid off existing debts, but a lot of people turned around and went and bought things. And so it's interesting that we have this political conversation today about price.
Right. And actually, we should go back to that for a second. I know we're almost out of time, but I want to say two things about that. Not only did they directly go out and buy stuff, but then we also had the supply chain disruption associated with COVID. So everybody was mandated to go home, which meant that all these production lines were shut down. So the goods that were in the system were available for purchase. They all got bought up, but then there was nothing behind it. So we had empty shelves. We had the inability to get things. And that's when we really started to see prices shoot up, because now critical components, supplies, and things that were needed were at a premium, and people started bidding them up with the money that they had available.
Absolutely. And Trump may have been aware of what was, the difference of Obama's method of giving the money to the banks and paying the banks to hold on to that money rather than allowing it to trickle down to American people or to individuals. I don't know if he did or not, but I do know that it is better for it's better for us to be aware of this problem rather than allowing the creation of fewer and fewer whales that dominate that dominate the reserve, that hold the bulk of the money. And so when I look at Trump 2.0 or his second administration's policies with tariffs, I don't know. I'm stymied by the BRICS war that he engages in against Russia and against China through the proxies of Ukraine and Israel and Iran. These are American primacy wars against Russia and against China, and it's not wars. It's actually just the same war. So it's interesting to see him. I'm constantly questioning his decisions or how much he realizes this, but at the same time he continues to adhere to the tariff narrative, to the idea of bringing manufacturing back to the United States. The only way to bring manufacturing back to the United States is actually to end the global dollar hegemony system. So I'm not sure how aware he is of it, but if he's breaking the system or creating a new one, I'm actually for it either way, because I find I find the unfairness and the disparity of the current system to be highly problematic, and I think that the more people that understand that, and the more that we get away from it, the better. So that's all I have. We didn't even get into quantitative tightening, but I don't know how different quantitative tightening is from quantitative easing. It's another broken tool in a corrupt system. Haha. There's my hot take to end it. Anything else, Grant?
A broken tool in a corrupt system. We'll see you next time on FOMO.